Welcome back, everyone. How old were you when you actively engaged in taking control of your finances and started investing? For some of us, this happens early in life, and we get decades to enjoy the sweet fruits that dividend investing can offer. But not all of us are so fortunate. For many, this mindset shift comes later in life, maybe in your 40s or 50s, or even in your 60s, with retirement looming just around the corner. Regardless of when you were introduced to investing, one thing is for sure: you shouldn't dwell on the fact that you would have been better off starting sooner. Instead, you should focus on making the best use of the time you have left. Today I want to speak to those of you who are older and just getting started, and to tell you that it's never too late to pursue a dividend investing strategy. Maybe it won't give you financial independence, but it can still significantly improve your financial situation. Let's start by looking at the case of a 60-year-old that is just starting out with no invested assets and 7 years left before they reach full retirement age. That's a very short period of time, so how much can this person really achieve in 7 years with dividend investing? The answer is quite a lot, relative to the time period and the effort they are willing to commit to building a dividend portfolio. At the very least, I think a person in this situation should look to open a Roth IRA and max it out every year until they retire. In 2023, you're allowed to contribute $6,500 per year to a Roth IRA, and an extra $1,000 if you're 50 years old or older. So this 60-year-old person can start contributing $7,500 to a Roth IRA every year, and continue to do so every year until they reach the age of 67 and retire, provided that they have enough earned income that is at least equivalent to their contribution, but not exceeding the income limit. The income limits vary depending on your tax filing status, but they're easily accessible on the web. You can simply Google 2023 Roth IRA income limits. The benefit of a Roth IRA is that you contribute after-tax dollars to this account, and you reap the reward later in life as you get to withdraw this money tax-free. If you build a dividend portfolio in a Roth IRA account, you will later have a tax-free passive dividend income stream that would essentially continue to pay you for as long as you live. Between the age of 60 and 67, you should have 8 calendar years. If you're able to sock away $7,500 per year, that would amount to a total investment of $60,000. If we assume you can attain a slightly lower than average market return of 8% per year, the value of this portfolio would be around $86,000 when you're 67 years old. That's a gain of about $26,000. Having a portfolio of $86,000 isn't going to be life-changing, but it's a hell of a lot better than not having a portfolio at all. If we assume this portfolio yields 3.5% and continues to generate an 8% annual return, how would this improve your retirement? Well, in the first year of your retirement, when you are 68 years old, your portfolio would pay you about $3,015 of passive dividend income. That's roughly $250 per month. Again, not a life-changing amount, but having $250 of extra tax-free income per month is better than not having it. This could help cover some of your expenses, or at the very least provide some financial flexibility. The best thing about a dividend portfolio: if done right, it will progressively pay you more money each year, helping to offset the impact of inflation. In this example, I'm assuming the dividend stream would grow at the same rate as the capital appreciation of the portfolio, or 4.5%. If I'm assuming that you can achieve an 8% return per year, and 3.5% of that return is coming from dividends, the other 4.5% must come from capital appreciation. At this rate of dividend growth, you could expect to receive about $11 more per month in year number 2, $12 more per month the following year, and so forth. About 5 years into retirement, you would start receiving about $300 per month. After 12 years, the monthly dividend payment would be $400. It would increase to $500 after 17 years, and $600 after 21 years. Let's assume you can live to the ripe age of 90, which would be 23 years of life in retirement. Under the financial assumptions I just laid out, you'd receive a total of about $117,000 in tax-free dividend income, just shy of twice the amount you originally contributed to this Roth IRA. The market value of your portfolio would also increase during these 23 years, from $86,000 at the start to about $237,000 at the end. When you combine the dividend stream and the portfolio value, the original $60,000 has now turned to about $354,000. That's nearly a 6 times multiple. Pretty neat, right? This growth in portfolio value would also give you additional flexibility. It could be used as an emergency fund that you could tap into if life presents you with any surprises. Of course, withdrawing any of this capital along the way would negatively impact your dividend stream and dividend growth, but we all know life happens whether we like it or not, and it's nice to have some assets socked away in case of an emergency. Alternatively, you could shift this portfolio to higher yielding stocks that would increase the monthly cash flow, typically at the cost of capital appreciation. This would give you more tax-free passive income without the need to liquidate your assets. Dividend income can really be an amazing addition to your other sources of income in retirement. This all may sound nice, but how do you actually make this happen? The most important question and the toughest decision for new investors is, where do I actually invest my money? There's many ways to answer this question, and no single answer will be ideal for every person. I'll give you an example of a starter dividend portfolio and a few options to consider in a moment. But first, I want to run through a few more scenarios for different age groups to show you what impact a few extra years can have on the final outcome. Let's say the person in my example was 55 years old instead of 60, and they have 5 additional years to fund their Roth IRA. Assuming we stick with the same $7,500 annual contribution, the 5 additional years allow you to contribute a total of $97,500 instead of the $60,000 in the original example. Not a major difference, but what you also get here is 5 additional years for your already contributed money to grow and compound. Let's take a look at the difference this can make. Since this person started funding their portfolio at the age of 55, and I'm using the same return assumption of 8% per year, at age 62, they would be in the same position as the 60-year-old was at the age of 67. They would have a portfolio with a market value of about $86,000. Between the age of 63 and 67, the now 55-year-old would continue adding $7,500 to their Roth IRA for a total contribution of $37,500. But their portfolio would increase from $86,000 at age 62 to about $174,000 at age 67. The portfolio would more than double, increasing by $88,000, of which $50,500 was a direct result of market growth rather than contributions. Pretty cool. In the first example for the 60-year-old, of the $86,000 portfolio, $26,000 was market gains and $60,000 were contributions. That equates to roughly about 30% of the portfolio coming directly from market growth. In the second portfolio, for the 55-year-old, of the $174,000 portfolio, $76,500 was market gains and $97,500 were contributions. That equates to roughly about 44% of the portfolio coming directly from market growth. So 5 extra years gives you roughly 14% more gains, onto an already larger contribution amount. Let's see what impact this would have on dividend income and future portfolio value. In the first year of retirement, this portfolio would pay a little more than $6,000 in tax-free dividend income, or a little more than $500 per month. So right around double the amount compared to the 60-year-old that had less time to invest. The dividend income would grow at the same rate in both examples, but since the 55-year-old had a higher starting dividend stream, the total amount of dividends paid would differ over the same period of time. If we again assume a 23-year retirement period, the 55-year-old could expect to receive a total of about $237,000 in dividends, which is about 2.4 times their original contribution. This portfolio would also be pretty close to reaching a $500,000 valuation in year 23 of retirement. I was curious, so I crunched the math for this same example, moving back 5 years at a time, all the way to starting at the age of 20, and the results kept getting exponentially better with more time. The amount of the market value at retirement that was a direct result of market gains kept improving, with the 20-year-old seeing about 90% of their portfolio value coming from market gains. The starting dividend income kept growing, and the total amount of dividends paid increased as a proportion of total contributions. Not to get off topic here, the point is not to dwell on what you could have done differently, but to focus on what you can do from this point forward. I think funding a Roth IRA for as many years as you possibly can is a very good first step. You can also fund your employer-sponsored 401k plan or a taxable brokerage account and try to grow your portfolio as large as you can before you retire. The next biggest drawback of starting later in life is that you have significantly less room to make mistakes when it comes to where you invest your money. Nobody can predict the future and tell you what type of market returns we will see in the next few years. If you aren't confident that you can outperform the average market return by selecting individual stocks yourself, then you are likely better off simply investing in an index fund that tracks a broad equity market. There are plenty of low-cost index funds that track the S&P 500. For example, VOO is a popular option from Vanguard. Alternatively, you can also invest in their total stock market fund, ticker symbol VTSAX, that casts an even wider net, giving you exposure to nearly 4,000 companies from across the entire globe. Hang on a second though. If you invest in an S&P 500 index fund, you're not really building a dividend portfolio, and that is not what I alluded to in my original example. Good point. What I'm suggesting here is, if you're not sure where to start or how to start with a simple index fund and give yourself time to learn about building a dividend portfolio along the way. If you do this in a Roth IRA, you can easily shift your assets with no tax consequences and design your perfect dividend portfolio by the time you're ready to retire. When I talked about limiting the number of mistakes you make, one of the biggest mistakes I think newer investors make is investing in the wrong companies. When you start out, most of your decisions will be based on what you read and who you listen to, with not a great deal of input coming from your own knowledge. I think this combination of information can lead to decisions you may feel were not ideal later in your investing career as you become more knowledgeable. So starting simple and building as you learn and gain confidence can be a way of avoiding some of these poor decisions. This was certainly the case for me. When I started, I made a whole lot of dumb decisions that seemed pretty great at the time. Ultimately, you should do what feels right to you and move at a pace you're comfortable with. As I promised earlier, let me now share with you a starter dividend portfolio of what I think are quality companies that would also give you a dividend yield of about 3.5%. This isn't a recommendation to go out and invest in any of these stocks, but simply an example to give you something to think about as you embark on your own dividend journey. It's a simple portfolio made up of the following 20 dividend-paying stocks: AbbVie, ticker symbol ABBV; Automatic Data Processing, ticker symbol ADP; Amgen, ticker symbol AMGN; Ares Capital, ticker symbol ARCC; Broadcom, ticker symbol AVGO; BlackRock, ticker symbol BLK; Domino's Pizza, ticker symbol DPZ; Home Depot, ticker symbol HD; Hormel, ticker symbol HRL; Johnson & Johnson, ticker symbol J&J; Lockheed Martin, ticker symbol LMT; Lowe's, ticker symbol LOW; Main Street Capital, ticker symbol MAIN; Realty Income, ticker symbol O; Pepsi, ticker symbol PEP; Procter & Gamble, ticker symbol PG; Starbucks, ticker symbol SBUX; Stag Industrial, ticker symbol STAG; T. Rowe Price Group, ticker symbol TROW; and Texas Instruments, ticker symbol TXN. These 20 companies pay varying dividend yields from a low of 1.38% for Domino's Pizza to a high of 10.04% from Ares Capital. But when you average all of them out, the portfolio yield would come out to be 3.5%. During the last 5 years, the average dividend growth rate for these 20 stocks was 10.55%, which is higher than what I used in my examples today. And the 5-year compounded annual growth rate for this portfolio would have been 12.2%, which is also higher than the 8% return I used today. This 12.2 return from the past 5 years is right in line with how the S&P 500 index performed. The only difference here would be that more of the return came in the form of dividends in this portfolio versus holding shares of the S&P. Some of these companies perform better than others, but that's already in the past, and it's the future that should interest you more. I don't know how they will perform in the upcoming 5 years, but I own all of these positions and I believe they are quality companies that should continue to deliver strong long-term results. Please keep in mind that this was just an example of a 20 stock portfolio that would meet a 3.5% dividend yield. And again, I'm not recommending that you invest in any of these stocks. You should invest in the way that makes sense to you. I started investing a while ago, and I initially was 100% invested in index funds. When I started learning about dividend stocks and decided to transition my portfolio into a dividend portfolio, I did it very slowly. This was partially due to the industry being less investor friendly, as trading cost money and I didn't want to incur a lot of fees. Each month, I would sell a portion of my index fund and invest all of the money into a dividend-paying stock. Sometimes I did this more than once per month, but it took me nearly a year to shift from an index portfolio into a dividend portfolio. As I mentioned earlier, I made a few mistakes along the way, mainly by investing based on other people's ideas and recommendations. So if I can leave you with a bit of advice, it would be to start investing today, go slow, and know that you have to break a few eggs to make an omelet. If you found this video insightful, please do me a big favor and give it a thumbs up and subscribe to my channel. Thank you for watching and see you next time.